Hey guys, Shola here for 2 Up on Wall Street. Welcome to the channel. Today we'll be talking about asset classes. After all, investing is all about acquiring them, so it's important to know what they are, what different types are out there, and any other questions you may have. So, without further ado, let's get active. So what is an asset? An asset is anything with monetary value that a person, company, or government owns or controls and hopes to financially gain from in the future. Assets are created, bought, or acquired to increase the holder's worth or provide financial gain now or in the future. For example, you could create an ebook or handcraft a bracelet today that you could profitably sell on Amazon tomorrow. Depending on who holds it, an asset can be a personal, corporate, or government asset. In this video, personal assets, which are assets owned by an individual or a household, are what we are referring to when we talk about assets. They could be financial, real or physical, or intangible personal assets. Examples of financial assets are cash in bank accounts, term or fixed deposits with banks, bonds, stocks, Bitcoin, and other financial products. Meanwhile, houses, cars, boats, jewelry, artworks, and bottles of vintage wine are a few examples of real or physical assets. Intangible assets include things like intellectual property, work experience, professional networks, education and skills, and even life insurance policies. In this video, we'll focus on personal financial and some real assets. People usually acquire these assets using the rewards of their intangible assets. For example, buying stocks with the salary you get from a job that you got using your educational skills. An asset class is an umbrella term for a collection of assets that share similar characteristics and market behavior. Broadly speaking, from most to least risky or volatile, asset classes include cash and cash equivalents, fixed income or bonds, equity or stocks, commodities, real estate, and alternatives like hedge funds, private equity, cryptocurrency, and collectibles. Each one of these asset classes has characteristics that influences its value over time. Cash and cash equivalents, bonds, and stocks are the three traditional asset classes, and these make up the bulk of most investment portfolios. Let's delve into each one, beginning with the most popular, equity or stocks. Suppose you own a small business and want to expand, but your ambition outstrips your financial capacity. How do you raise funds? Well, you basically have two choices. You could borrow the needed funds from willing lenders with a commitment or bonds to repay them with interest. This means that you issue your lenders debt or bonds. Or you could give up some ownership of the business to keen investors in exchange for the funds. This means that you issue your investors equity or stocks in the business. Let's explore that second option and peek into the world of the equity asset class. As the owner of that business, you would publicly list the business on a stock exchange like the New York Stock Exchange. That's done through an initial public offering or IPO, which lets you sell slices of ownership in the business to the public. Those ownership slices are called shares or equity, and the buyers become shareholders in your newly minted publicly traded company. So you get the funds you need, the shareholders get a stake in the company in exchange for investing in your vision, and the return on their investment is now linked to the profitability of the business. If a business earns a profit, it may pay out a portion of that to its shareholders as dividends. It could also reinvest the profits into growing more value, either in-house or by acquiring other businesses. Moreover, it could buy back some of its shares from the stock market, which reduces the supply of tradable shares and boosts the price of outstanding shares, making its shareholders' holdings more valuable. On the other hand, if a business makes a loss, it may cut dividend payments to its shareholders or stop them entirely. It could also be unable to improve or expand operations and acquire assets or other businesses, unless by dipping into its cash reserves or going into debt, which could spell more trouble ahead. The same goes for share buybacks. An unprofitable business could do it, but only by draining cash reserves or borrowing. In a nutshell, the more profitable a business becomes, the more valuable or in demand its shares get in the stock market, which raises its share price. The opposite is true for an increasingly unprofitable business. So, if a shareholder sells their shares in a consistently profitable business, they would likely do so at a price higher than they originally paid for them. In other words, they would gain on their capital or realize a capital gain. So dividends and capital gains are the two ways you can realize an economic benefit from equity assets. On the flip side, if a shareholder sells their shares in a consistently unprofitable business, they would likely do so at a price lower than they originally paid for them. In other words, they would lose on their capital or realize a capital loss. Moreover, unprofitable businesses eventually go bankrupt, which means total capital loss for shareholders. Clearly, equity assets are very risky as your principal is not guaranteed. In fact, when the company goes bankrupt, it liquidates its remaining assets by selling them off for cash, and it must settle its debts first before its shareholders get any leftovers. That brings us to different types of shares and the rights they give to shareholders. Broadly speaking, we have ordinary or common shares and preferred shares. Moreover, preferred shares can be of cumulative, convertible, redeemable, or retractable type. Ordinary or common shares grant shareholders voting rights on business decisions, but they come with variable rate unguaranteed dividends, as well as the lowest priority for both dividend payment and, in a bankruptcy, capital repayment. On the other hand, preferred shares do not grant shareholders voting rights on business decisions, but they grant them fixed-rate guaranteed dividends and the highest priority for both dividends and, in a bankruptcy, capital repayment. With cumulative preferred shares, if the business issued dividends but missed paying them in the past, all unpaid dividends accumulate and must be paid to shareholders in the future. Meanwhile, with common shares, missed or unpaid dividends are gone forever. Common shares usually have larger capital appreciation or share price growth than preferred shares. With preferred shares, the bulk of the returns are the guaranteed dividends. With convertible preferred shares, each share is eligible for conversion into a predefined number of common shares, either at any time the shareholder wants or after a restricted period. Meanwhile, common shares cannot be converted into preferred shares at any time. With redeemable or callable preferred shares, the business has the right to sell the shares back to the shareholder at a preset price after a preset date. Meanwhile, common shares belong to the shareholders forever until they decide to sell them. With retractable preferred shares, the shareholder has the right to sell the shares back to the company at a preset price after a preset date. But if they don't initiate a sale by that date, the business has the right to force them to do so in what's called a hard retraction. In some cases, the business will convert those preferred shares into common shares instead of paying cash to the shareholder in what's called a soft retraction. Meanwhile, all of this doesn't apply to common shares, which the shareholder owns forever until they decide to sell them. Now let's see the different ways the equity asset class is further diced and spliced. According to the Global Industry Classification Standard, or GICS, there are 11 equity sectors. They include communication services, consumer discretionary or consumer cyclical, consumer staples, also known as consumer defensive, energy, financials, healthcare, industrials, information technology, or technology for short, materials or basic materials, real estate, and utilities. Moreover, the US equity market is the big kahuna with roughly 60% of the global equity pie. These 11 equity sectors can be grouped into defensive, cyclical, and sensitive buckets based on how correlated their performance is with the overall economy. Equity sectors in the defensive bucket are consumer staples, healthcare, and utilities. Defensive stocks provide consistent dividends and stable earnings regardless of the state of the overall economy. That's because there's a constant demand for their products, so they tend to be more stable during different business cycles, which means they have low volatility or risk, resulting in smaller downside in economic bursts and smaller upside in economic booms. Equity sectors in the cyclical bucket are materials, consumer discretionary, financials, and real estate. Cyclical stocks provide fluctuating dividends and earnings that correlate with the overall state of the economy. That's because there's a cyclical demand for their products, with higher demand in economic booms and lower demand in economic burst phases, which means they are more volatile than defensive stocks, with larger downside in bear markets and larger upside in bull markets. Equity sectors in the sensitive bucket are communication services, energy, industrials, and technology. They are more affected by the ebb and flow of the economy than defensive stocks, but not as much as cyclical stocks. It's interesting to note the similarity in the US and global capital allocations to each sector, but there is divergence when it comes to materials and industrials, where the rest of the world allocates more capital than the US, and technology and healthcare, where the US allocates more capital than the rest of the world. So what defines businesses in each equity sector? Also, what are the largest companies in each sector? Let's find out. Consumer staples sector includes businesses meeting consumer needs whose revenue is not tied to the consumer's disposable income. The sector covers industries like food, beverage, tobacco and cigarette, household and personal care products, and supermarket chains. Looking into these industries globally, we see that The largest food companies are Nestle, McDonald's, and Unilever. In the beverage industry, Kwechao Moutai, Coca-Cola, and PepsiCo are the biggest businesses. Philip Morris International, Altria Group, and British American Tobacco are the leading tobacco and cigarette firms. In the household and personal care products industry, Procter & Gamble, Colgate-Palmolive, and Reckitt Benckiser are the largest companies. Lastly, Walmart, Costco, and Target run the biggest supermarket chains in the world. The healthcare sector covers companies that develop drugs and treatments or provide healthcare equipment and services. The sector includes industries like pharmaceuticals and treatments development, medical devices manufacture, testing and diagnostics, health insurance, medical care facilities, and telehealth services. Looking into these industries globally, we see that the largest pharmaceuticals and treatments development firms are Eli Lilly, Novo Nordisk, and Johnson & Johnson. Among medical devices manufacturers, Abbott Laboratories, Stryker Corporation, and Intuitive Surgical are the biggest businesses. The leading testing and diagnostic companies are Thermo Fisher Scientific, IDEX Laboratories, and Quest Diagnostics. The largest health insurers are United Health Group, Elevance Health, and CVS Health. AIER Eye Hospital Group, Bangkok Dusit Medical Services, and Herdo St. Louis run the biggest medical care facilities in the world. Lastly, Doximity, Teladoc Health, and LifeStance Health are the leading telehealth companies. The utilities sector includes companies that provide services in the electric, water, gas, and renewable energy fields. The sector covers industries like electrical power generation, transmission or distribution, natural gas transmission and distribution, water supply, renewable power production, and diversified utility. Looking into these industries globally, we see that the largest electrical power generators, transmitters, or distributors are NextEra Energy, China Yangtze Power, and the Southern Company. Among natural gas transmitters and distributors, Naturgy Energy Group, the Hong Kong and China Gas Company, and Atmos Energy Corporation are the biggest firms. American Water Works Company, Severn Trent, and Essential Utilities Inc. are the largest water suppliers. The leading renewable power producers are Constellation Energy Corporation, Verbund AG, and CEZ AS. Lastly, Iberdrola, Enel, and ACWA Power Company are the largest diversified utility companies in the world. The materials sector covers companies that provide various goods for use in manufacturing and other applications. The sector includes industries like chemicals, construction materials, packaging and containers, metals and mining, and paper and forest products. Looking at these industries globally, we see that the largest chemical companies are Lind plc, Air Liquide, and Merck. Cement Roadstone Holding, Holcim SA, and Ultratech Cement are the biggest construction materials businesses. The leading packaging and containers firms are Avery Dennison Corporation, Ball Corporation, and Packaging Corporation of America. BHP Group, Rio Tinto, and Glencore are the largest metals and mining companies. Lastly, the biggest paper and forest products firms are Klabin, UPM, and Suzano. The consumer discretionary sector includes businesses meeting consumer wants, whose revenue depends on consumers' disposable income. The sector includes industries like automotives, luxury and sporting goods, hotels, restaurants and travel, e-commerce and retail, entertainment, and cosmetics and beauty. Looking into these industries globally, we see that Tesla, Volkswagen, and BYD Auto are the biggest automakers. The largest luxury and sporting goods makers are Louis Vuitton, Moet Hennessy, Nike, and Adidas. Marriott International, Bookings Holdings, and McDonald's Corporation are the leading hotels, restaurants, and travel companies. The largest e-commerce and retail firms are Amazon, Walmart, and Rakuten. Comcast Corporation, the Walt Disney Company, and AT&T are the biggest entertainment firms. Lastly, the largest cosmetic and beauty firms are L'Oreal, Estee Lauder, and Govardhan. The financial sector covers companies that mainly handle money. The sector includes industries like banking, insurance, brokerage houses, consumer finance, mortgage-related real estate investment trusts or REITs, and financial technology or fintech. Looking into these industries globally, we see that JP Morgan Chase, Industrial and Commercial Bank of China, and Bank of America are the largest banks. The biggest insurance firms are China Life Insurance, Ping An Insurance, and AIA Group. The Charles Schwab Corporation, Bank of America's Merrill Lynch, and JP Morgan Chase are the leading brokerages. The biggest consumer finance providers are Visa, MasterCard, and American Express. Annaly Capital Management, Starwood Property Trust, and AGNC Investment Corp are the largest mortgage-related REITs. Lastly, the biggest fintech companies are Intuit, Fiserv, and PayPal. The real estate sector includes property developers and managers and real estate investment trusts or REITs. The sector includes industries like property management, shopping malls, public storage, healthcare facilities, communications real estate, digital infrastructure, and industrial real estate. Looking into these industries globally, we see that the largest property managers are CBRE Group, Jones Lang LaSalle, and Colliers International Group. Simon Property Group, Realty Income Corporation, and Regency Centers Corporation are the biggest shopping mall owners. The leading public storage providers are Public Storage, Extra Space, and CubeSmart. Welltower Inc., Ventus, and Health Peak Properties are the largest healthcare facility owners. The biggest communications REITs are American Tower, Crown Castle, and SBA Communications. Equinix, Digital Realty Trust, and Iron Mountain are the leading digital infrastructure REITs. Lastly, the largest industrial REITs are Proluxis, Rexford Industrial Realty, and East Group Properties. The communications services sector covers businesses that transmit data as text, voice, audio, or video across the globe. The sector includes industries like wireless communications, telecom equipment manufacturing, and telecom services. Moreover, telecom services covers fields like internet services and traditional TV, social media, internet search and digital advertising, video games, streaming, and traditional advertising. Looking into these industries globally, we see that China Mobile, T-Mobile, and Verizon Communications Inc. are the largest wireless communications firms. The biggest telecom equipment manufacturers are Cisco Systems, Foxconn Industrial, and Motorola Solutions. In the telecom services industry, Comcast is the largest internet services and traditional TV company. The biggest social media business is Meta Platforms Inc., formerly known as Facebook. Alphabet or Google is the leading internet search and digital advertising firm. The largest video game creator is Microsoft's Activision Blizzard Inc. Netflix is the biggest streaming company. Lastly, the largest traditional advertising business is Publicis Group. The energy sector includes businesses that operate in the oil and natural gas space. The sector includes industries like oil and gas exploration and production, consumable fuels production, and oil and gas industry equipment, materials, and services provision. The sector doesn't include renewable energy companies, as those are considered utilities. Looking into these industries globally, we see that the biggest oil and gas exploration and production firms are Saudi Aramco, ExxonMobil, and Chevron Corporation. China Shenhua Energy, Coal India, and Glencore are the largest consumable fuels producers. Lastly, the leading oil and gas industry equipment, materials, and services providers are Schlumberger, Halliburton, and Baker Hughes. The industrial sector covers a variety of businesses that utilize heavy equipment. The sector includes industries like transportation, aerospace, defense, construction, engineering, and equipment and machinery manufacturing. Looking into these industries globally, we see that the largest transportation companies are Delta Airlines, Union Pacific Corporation, and Hapag-Lloyd. Honeywell, Boeing, and Airbus are the biggest aerospace firms. The leading defense companies are Lockheed Martin, Raytheon Technologies, and Northrop Grumman. Vinci SA, Larsen & Toubro, and D.R. Horton are the largest construction businesses. The biggest engineering firms are Siemens, ABB, and Hitachi. Lastly, Caterpillar, John Deere & Company, and United Heavy Machinery are the largest equipment and machinery manufacturers. The information technology sector includes companies involved in different aspects of technological innovation. It is the largest among the 11 GICS equity sectors and includes industries like Internet software and services, IT consulting and services, cybersecurity, artificial intelligence, data processing and services, and application software. Looking into these industries globally, we see that the largest internet software and services companies are Alphabet, Amazon, and Meta Platforms. Accenture, Tata Consultancy Services, and Automatic Data Processing are the biggest IT consulting and services firms. The leading cybersecurity businesses are Palo Alto Networks, Fortinet Inc., and CrowdStrike Holdings. Microsoft, Alphabet, and Tesla are the largest artificial intelligence companies. The biggest data processing and services firms are Amazon, Alphabet, and Microsoft. Lastly, Salesforce, SAP, and Intuit Inc. are the leading application software businesses. The information technology sector also includes industries like database management, home entertainment software, consumer electronics, computer hardware, and scientific and technical instruments. Looking into these industries globally, we see that the leading database management firms are Oracle, Microsoft, and IBM. Netflix, Disney, and Microsoft Activision Blizzard are the largest home entertainment software companies. The biggest consumer electronics businesses are Apple, Samsung, and Sony. Dell Technologies, HP, and Western Digital Corporation are the leading computer hardware firms. Lastly, the largest scientific and technical instrument firms are Keyence Corporation, Fortive Corporation, and Hexagon. The massive IT sector also includes industries like electronic component manufacture, semiconductor manufacture, electronics and computer distribution, semiconductor equipment and materials production, and solar energy technology. Looking into these industries globally, we see that the largest electronic component manufacturers are Amphenol Corporation, Foxconn Industrial, and TE Connectivity Limited. Nvidia, TSMC, and Broadcom are the biggest semiconductor manufacturers. The leading electronics and computer distributors are CDW Corporation, TD Synex Corporation, and Arrow Electronics Inc. ASML Holding, Applied Materials, and Lam Research Corporation are the largest semiconductor equipment and materials producers. Lastly, the biggest solar energy technology firms are First Solar, Enphase Energy, and Jinko Solar. Equities can also be grouped by market capitalization or market cap, which is what the market thinks the underlying business is worth. This results in 5 equity groups: micro, small, mid, large, and mega cap stocks. Microcaps are businesses valued under $250 million, for example, Semler Scientific and VitalHub Core. They are the most volatile, riskiest, and illiquid market cap category. Illiquid meaning it's not easy selling their shares, usually due to low trading volumes. Moreover, the scarce data on them makes research difficult, which leaves investors vulnerable to fraud and other risks. Small caps are businesses valued between $250 million and $2 billion. Good examples are Agilicis Inc. and Docebo Inc. They have historically outperformed larger cap stocks, but they are also more volatile, riskier, and less liquid. Moreover, some of them are plagued by the same issues as microcaps, that is, lack of information and illiquidity. Mid-caps are businesses valued between $2 billion and $10 billion. Good examples are Elf Beauty Inc. and Descartes Systems Group. As their name implies, they are in the middle of their growth story and are projected to keep growing earnings and market share. Moreover, they provide diversification in the portfolio by contributing a balance of growth and stability. Large caps are businesses valued between $10 and $200 billion. Great examples are Paycom Software Inc. and Manulife Financial Corporation. They dominate the major benchmark indices across the globe, for example the S&P 500. These firms are usually transparent, making sufficient data publicly available to ease investors' research. Moreover, they are typically blue-chip companies at the peak of their business cycle phases, producing established and stable revenue and earnings with lower volatility and often pay dividends. As a result, they normally form the core of most investors' long-term strategy. Megacaps are businesses valued over $200 billion. A great example is Microsoft Corporation. Another one is Alphabet Inc. These Goliaths sell tons of goods and services in any reporting period and as such have an outsized influence in the industries in which they operate. But that's a double-edged sword because if these firms experience a persistent slump, the broader market could be heavily affected. So while megacaps share a lot of benefits with large caps, for example transparency, data availability, stable returns, and lower volatility, they do come with a fair amount of concentration risk. Equities can also be grouped by market classification or location, that is, where the businesses mainly operate in. Doing so results in developed and emerging market equity groups on one hand, and on the other, local and foreign equity groups. Developed markets have higher household incomes, adequate infrastructure, and mature capital markets, meaning their markets have greater stability, transparency, and liquidity. They have well-regulated exchanges, established trading platforms, and investor protection mechanisms. Developed markets are mostly located in North America, Western Europe, and Australasia. Emerging markets have rapid economic growth and development, which are driven by younger populations, higher consumption levels, and a strong modernization drive. But they also have lower household incomes, inadequate infrastructure, immature capital markets, and bouts of political and economic instability. Emerging markets mainly include Brazil, Mexico, Saudi Arabia, Russia, India, Indonesia, China, and Taiwan. As a Canadian, when you buy Canadian stocks, you're buying local equities. But when you buy US stocks or stocks from outside Canada, you're buying foreign equities. The world doesn't entirely revolve around the US and the developed markets, and change is the only constant. In fact, current projections see emerging markets outgrowing their developed counterparts by the mid-2040s. Moreover, 2024 earnings growth forecasts show 19% earnings growth for emerging markets, beating the US's 10% and the developed markets' 8% earnings growth projections. Right, that does it for equities. Next, we'll delve into the fixed income or bond asset class. Suppose you own a small business that you want to expand, but you're strapped for cash. Yet, you don't want to sell ownership stakes or shares, or you've already sold all the shares you're comfortable selling. Well, you could borrow the needed funds from willing lenders with a commitment or bond to repay with interest. That means you issue them bonds or debt. Those lenders now own your business's debt and become its bond holders. Let's explore how all that works and peek into the world of the fixed income or bond asset class. Businesses and governments can obtain outside funds by borrowing. They do so by issuing bonds or selling debt to interested lenders. These bonds have a fixed or variable interest, a set payment frequency, and an agreed repayment period. A bond's interest payment is also called a coupon, and its repayment period is also called its duration. Bonds reach maturity at the end of their duration. At that time, the borrower or bond issuer must return the amount they borrowed or the principal back to the lenders or bondholders. For some bonds, the issuer has the right to pay off or call the debt early and stop making coupon payments to bondholders. These are known as callable or redeemable bonds. Moreover, a single lender is rarely able to meet a borrower's need. That's why bonds are usually issued in units, so each lender can buy as many units as they can afford. And the bond's coupon and duration apply equally to each unit sold to the bondholders. The price of a bond and the coupon it will pay to bondholders depends on the prevailing and anticipated inflation and interest rates, as well as the bond issuer's likelihood of default. Default being the situation where the bond issuer is not able to pay the coupons in line with the payment interval or repay the principal at the bond's maturity. The positive correlation between inflation and interest rates is well established, since raising interest rates is the main tool central banks use to control rising or high inflation. This chart from Luisa Vieira illustrates the relationship between the two. High or rising inflation and interest rates during a bond's duration means the bondholder's principal and coupons will be worth less when they receive them in the future. So the yield or interest rate on bonds being issued in such periods needs to be high enough to compensate bondholders for the inflation and interest rate risk. In such times, bond issuers are limited in the asking price they can set for their bonds, as they need to make the bonds more attractive given the possibility that interest rates will rise during the bond's duration. Lenders can simply wait for bonds issued in the future at those higher interest rates instead of buying now, and this lack of demand would further drive down bond prices today. Bondholders can also resell their bonds to other lenders before maturity. Relative to the bond's original issue price, face value or par, the resale can occur at a lower price or at a discount to par and the seller records the capital loss. Or the resale could occur at a price equal to par and the seller recoups their full principal they invested in the bond. Or the resale could occur at a higher price or at a premium to par and the seller records the capital gain. Like the original issue price, the resale price is inversely related to the available interest rates on similar bonds at the time of the resale, and that's tied to current and expected inflation. So in a rising or high inflation and interest rate environment, borrowers or bond sellers sell their bonds at lower prices while offering higher interest or coupons. The opposite is true in a low or falling inflation and interest rate environment. As a rule of thumb, for each percentage rise or fall in interest rate, a bond's price falls or rises by the value of its duration, expressed as a percentage. So a 10-year duration bond's price will fall or rise by 10% for each 1% rise or fall in interest rates. This explains why when inflation and interest rates fall, bond issuers pay off redeemable or callable bonds before their maturity. The bondholders only get the bond's value at the preset call price, which is usually the face value, so they get their principal back, but they lose the interest payments for the remaining duration. Meanwhile, the bond issuers can reissue the called bonds at a higher price and lower coupon rates. A borrower's credit risk is summed up in its credit worthiness, which is like the credit score people get based on things like their income and loan repayment history. Moody's, Standard & Poor's, and Fitch are the three main global credit ratings agencies that evaluate and publish credit ratings of governments and corporations. For example, Standard & Poor's or S&P rates borrowers on a scale of AAA for strong, AA for satisfactory, A for adequate, B for uncertain, C for likely default, and D for already in default. However, these ratings agencies are not faultless, and as John Maxfield wrote for the Motley Fool, ratings agencies are always the last to know when there's trouble lurking in a borrower's books. For instance, Standard & Poor's had an A credit rating for bonds issued by Lehman Brothers, then the fourth largest US investment bank, when the bank went bankrupt in the 2008 subprime mortgage crisis. Nevertheless, a borrower's credit rating is important, and the better it is, the lower the bond issue price and coupon it has to offer to attract lenders. So, Borrower's default is not the only way bondholders can lose money on bonds. That also happens if borrowers pay their debt early or call their bonds, or if bondholders resell their bonds at a price below par due to prevailing inflation and interest rates rather than holding them to maturity. Taking call risk, inflation risk, and interest rate risk together with borrower's default or credit risk, it's clear that although fixed income assets are significantly less risky compared to equities, they are not risk-free. Now let's see the different ways the fixed income or bond asset class is further diced and spliced. There are 5 ways bonds can be classified: by borrower or issuer type, bond duration, borrower's creditworthiness, the bond coupon type, or the borrower's location. Bond issuers could be national or sovereign governments, government-backed agencies, municipal or local governments, and corporations or businesses in the private sector. Bond durations can be ultra-short, short, intermediate, long, or ultra-long term, depending on the number of years to maturity. Depending on the bond issuer's credit rating, its bonds are classified as investment grade, non-investment grade, high yield or junk, and non-rated bonds. Based on the type of coupon a bond pays, it can be a fixed rate, floating rate, or zero coupon bond. Lastly, depending on where a bond issuer is located, its bonds can be developed or emerging market bonds, or local or foreign bonds. Now let's take a closer look at each of these bond classes. Government bonds are issued by central banks like the US Treasury and the Bank of Canada as bills with duration less than or equal to a year, or notes having 1 to 10 years duration, or bonds with duration greater than 10 years. These bonds are backed by the full faith and credit of the issuing governments, and their coupons are serviced by the issuer's taxation powers, making them the most creditworthy or low-risk but lowest-yielding bonds. Some notes and bonds, like Canadian Real Return Bonds and US Treasury Inflation Protected Securities or TIPS, offer inflation protection by altering their principal and coupon rates with changes in the Consumer Price Index and providing a real rate of return. A cool feature of government bonds is that their interest payments are subject to federal income tax but exempt from state and local taxes. Some governments also issue small denomination saving bonds to individual investors. These pay no coupons but are issued at a discount to their face value and are not subject to state, provincial, or local taxes. The difference between their discounted price and face value is realized by the bondholders at maturity and acts as a fixed interest over the bond's duration. While the US Treasury still issues saving bonds like the Series EE or Series I bonds, the Bank of Canada has stopped doing so, and only the province of Quebec still does in Canada. Agency bonds are issued by government-affiliated entities and are either direct obligations of the government or fully guaranteed by the government. Their government backing makes them very creditworthy or low risk, but also lower yielding. That said, they offer higher coupons than government bonds while being slightly riskier. Examples of agency bonds in Canada are mortgage bonds issued by the Canada Mortgage and Housing Corporation, CMHC. In the US, we have the Federal National Mortgage Association, or Fannie Mae, and the Federal Home Loan Mortgage Corporation, or Freddie Mac. Municipal bonds or munis are issued by local governments to bankroll daily spending on capital projects like building roads, parks, and schools. They can be general obligation, revenue, or conduit municipal bonds based on how their principal and coupons are backed. General obligation bonds are backed by the taxes the municipality collects from residents. Revenue bonds are backed by the revenue the municipality generates from the capital project they borrowed against. For example, highway tolls. Lastly, conduit bonds are backed by the third party on whose behalf the municipality issued the bond. For example, non-profit colleges or hospitals. Municipal bond coupons are usually exempt from federal income tax, and if the bondholder lives in the municipality, they are always exempt from state and local taxes too. With these tax advantages in mind, municipal bond issuers usually offer lower interest or coupon rates compared to other types of taxable bonds with similar duration and creditworthiness. Corporate bonds are issued by corporations and businesses to raise funds instead of borrowing from banks at higher interest rates or issuing new shares and diluting existing shareholders. Companies are usually less creditworthy than governments, government agencies, and municipalities, so corporate bonds offer higher interest rates to compensate for the higher risk. An example of a corporate bond was Apple Inc.'s May 2014 bond issuance. Aside from company debt like Apple's, Canadian banks, trust companies, and brokerages issue guaranteed investment certificates or GICs to their depositors. Certificates of deposits or CDs are the US version of GICs issued by banks, credit unions, or brokerages to depositors in the United States. GICs and CDs are issued with fixed or variable interest rates, and their principals or deposits are usually insured by the Canada Deposit Insurance Corporation (CDIC) or in the United States by the Federal Deposit Insurance Corporation (FDIC). GICs and CDs are term deposits with 3 months to 5 years duration, and they come in 3 main types: cashable, redeemable, and non-redeemable. Cashable ones allow no penalty anytime early withdrawals. The redeemable ones penalize early withdrawals, and withdrawals are only possible after a holding period. Meanwhile, the non-redeemable ones do not allow early withdrawals and must be held to maturity. GICs and CDs are not exactly corporate debt, and their issuers are not the government or government-linked, but they do offer you guaranteed interest and principal for the opportunity to turn a profit using your deposits. In October 2023, the highest yielding CDIC-insured 1-year duration GICs in Canada were from Oaken Financial, Wealth One Bank of Canada, and People's Bank. Meanwhile, in the US, the top 3 yielding FDIC-insured 1-year duration CDs were from Popular Direct, Merrick Bank, and the Lending Club. Classifying bonds by duration results in ultra-short, short, intermediate, long, and ultra-long-term bonds. Ultra-short-term bonds have a duration less than a year, and a good example ETF for this is iShares Ultra Short-Term Bond ETF. Short-term bonds have a duration from 1 to 3 years, and a good example for this is Vanguard's Short-Term Bond Index Fund. Intermediate bonds have a duration from 4 to 10 years, and a good example ETF for this is Vanguard's Intermediate Term Bond Index Fund. Long-term bonds have a duration from 11 to 20 years, and a good example ETF for this is Vanguard's Long-Term Bond Fund. Finally, ultra-long-term bonds have a duration exceeding 20 years, and a good example ETF for this is Vanguard's Extended Duration Treasury Index Fund. These bonds could be issued by any of the bond issuers discussed earlier, and they usually pay higher interest with increasing duration or exposure to risk. We've talked about the relationship between bond duration and changes in inflation and interest rates. Let's see how that looks for bonds of different duration using government-issued bond ETFs as a proxy. Comparing the bond price and yields of bond ETFs with varying durations over the last decade, we see that rising interest rates is accompanied by falling bond prices and rising bond yields. Also, shorter duration bonds are best suited to high or rising interest rate environments as their price falls the least while their yield rises quickly. We also see that falling interest rates is accompanied by rising bond prices and falling bond yields. Also, longer duration bonds are best suited to low or falling interest rate environments as their price rises the most while their yield falls slowly. Investment-grade bonds are those issued by borrowers the bond market believes have a lower likelihood of default and, as a result, higher credit ratings. Bonds rated Baa or above by Moody's and BBB or above by S&P and Fitch are investment-grade bonds. Since investment-grade bonds have lower default risk, they also offer lower coupon rates or yields. Government agency, general obligation, municipal, and some corporate bonds fall into this category. Non-investment grade bonds are those issued by borrowers the bond market believes have a higher likelihood of default and, as a result, lower credit ratings. Bonds rated lower than Baa by Moody's or BBB by S&P and Fitch are non-investment grade bonds. Since non-investment grade bonds have a higher default risk, they also offer higher coupon rates or yields and are commonly called high-yield, speculative, or junk bonds. Most bonds issued in emerging markets fall into this category. In developed markets, some corporate bonds fall into this category, usually those issued by startups, capital-intensive firms with high debt-to-equity ratios, and fallen angels, which are bond issuers that previously had high credit ratings. Non-rated bonds are those issued by borrowers whose creditworthiness has not been rated by a reputable credit ratings agency. Examples would be revenue and conduit municipal bonds from states, provinces, cities, and local governments. Fixed-rate bonds pay the same interest or coupon throughout their duration. The decreased interest rate risk usually comes with a lower coupon rate. Examples of fixed-rate bonds are U.S. Certificates of Deposit or CDs and Canadian Guaranteed Investment Certificates or GICs. Floating-rate bonds pay interest or coupons that vary with market interest rates. Interest rate risk is prominent here, so these bonds make sense when lenders expect market interest rates to rise. Examples of floating-rate bonds are Canadian Real Return Bonds or RRBs or Treasury Inflation Protected Securities or TIPS in the US. These bonds have coupon rates that adjust to the Consumer Price Index or CPI every 6 months. Zero-coupon bonds do not pay coupons. Instead, they offer a discounted purchase price relative to the bond's face value, and the bondholder gets the face value at maturity. The difference between the discounted price and the face value is the bondholder's total return, which mimics the fixed rate of return over the bond's duration. Notably, holders of zero-coupon bonds with multi-year durations must pay taxes on a yearly basis, even though they do not actually receive any income until the bond matures. Examples of zero-coupon bonds are US or Canadian Treasury bills. Bonds are issued by governments, businesses, or corporations in countries around the world. As this chart from Visual Capitalist shows, 45% of the global bond market is in the US, 29% is in China, and 20% is in the EU. If your bonds were issued in a location outside your country of residence, then you've acquired foreign bonds. Otherwise, you own local bonds. Developed market bond issuers are generally more creditworthy than their emerging market counterparts. However, one reason to be interested in government bonds issued outside of the developed markets is the relatively lower debt-to-GDP ratio of the issuing governments. Here are 2 more reasons to explore emerging market bonds. To start with, looking backward, their real rate of return accounting for inflation has been higher than those in developed markets. In addition, looking forward, their interest rates are forecast to remain high or rise further. Finally, currency risk is a huge factor to consider when looking at emerging market government bonds or any other emerging market bonds. But there are currency hedges available to blunt that risk. Right, that does it for fixed income. Next, we'll delve into the cash and cash equivalents asset class. Cash and cash equivalents are financial assets that are either cash or instantly convertible to a known amount of cash. Cash is exactly that, money in hand, but it also refers to money in a savings, checkings, or brokerage account where it may earn a return or interest. Cash equivalents are secure, ultra-short-term, and practically risk-free cash or debt instruments that return a fixed or variable interest. That means their issuers have high credit ratings, their durations are less than a year, and they usually guarantee the principal or deposit. The interest cash and cash equivalents return depends on the prevailing inflation and interest rates. The higher those are, the higher the interest cash equivalents will pay. Moreover, cash and cash equivalents are low risk and low return assets, but only when inflation is not rising. When inflation rises, they lose value or purchasing power as they are worth increasingly fewer goods and services. That said, their value is fairly stable, and they are a great vehicle to carry your emergency fund or money you need for upcoming expenses like saving for a wedding in a few months. Cash equivalents include treasury bills or T-bills, high-interest savings accounts or ISAs, ultra-short-term cashable or redeemable guaranteed investment certificates or GICs in Canada, ultra-short-term cashable or redeemable certificates of deposit or CDs in the US, money market funds or MMFs, and cash exchange traded funds or ETFs. Now let's take a closer look at each of these. Treasury bills or T-bills are ultra-short-term zero-coupon government debt that the public buys at a discount directly from the government or from financial institutions. The issuing government guarantees the buyer's principal and interest with the full faith and credit of the government and its taxation powers. The interest is the discount on the T-bill's face value that the government offers you to borrow it money, and at maturity, the government pays you the T-bill's face value. For instance, you pay $95 for a $100 T-bill after a 5% discount, and you get $100 back when it matures. That nets you a 5.26% effective interest rate on your $95 investment. The charts you see here show that the US and Canadian governments are currently offering about 5% discount on T-bills. Moreover, unlike all the other cash equivalents we'll look at, the interest from T-bills are only subject to federal tax, not state or provincial taxes. High-interest savings accounts or HISAs are savings accounts with interest rates much higher than regular savings accounts and are offered by banks or discount brokerages to their depositors. In Canada, HISA deposits are usually guaranteed by the Canada Deposit Insurance Corporation or CDIC up to $100,000. Meanwhile, in the United States, the Federal Deposit Insurance Corporation or FDIC does the same but insures up to $250,000 of deposits. Being savings accounts, HISAs don't have meaningful fees linked with owning them, but like most bank accounts, they normally have a small account maintenance fee. This graphic shows the top 3 highest HISA rates currently offered by financial institutions in Canada and the United States. Comparing this to the T-bills discount charts we saw earlier, you can say that it's probably better to invest in T-bills over HISAs in Canada and HISAs over T-bills in the US. Guaranteed Investment Certificates or GICs are Canadian fixed or floating interest rate term deposits. For GICs to be cash equivalents, they have to be ultra short-term, cashable or redeemable type and have fixed interest rates. Ultra short-term means the GIC's duration is 1 year or less. Cashable means the GIC allows early withdrawals at any time without penalties. Redeemable means the GIC allows but penalizes early withdrawals and only allows them after a holding period. GICs are offered to depositors by Canadian banks, trust companies and brokerages, and their principals or deposits are usually guaranteed by the Canada Deposit Insurance Corporation or CDIC or other provincial deposit insurance programs. Certificates of Deposit or CDs are the US version of GICs. They are issued by banks, credit unions or brokerages to depositors in the United States. Moreover, their principals or deposits are normally insured by the Federal Deposit Insurance Corporation or FDIC. GICs and CDs do not have any fees linked with owning them, not even the small account maintenance fee that HISAs usually have. This graphic shows the top 3 highest GIC and CD rates currently offered by financial institutions in Canada and the United States. Comparing this to the T-bills discount charts we saw earlier, you can see that it's probably better to invest in T-bills over GICs in Canada and CDs over T-bills in the United States. Money market funds are mutual or exchange-traded funds or ETFs having at least 95% of their holdings in other cash equivalents with average duration less than a year. They are offered by mutual fund firms, banks, wealth managers, and brokerages and function like savings accounts. But unlike savings accounts, their returns fluctuate daily and their principals are not CDIC or FDIC insured. Aside from their uninsured principals and variable yields, their returns are also impacted by their management expense ratios and fees. Although this is more of an issue in Canada, where these fees are much higher than in the US. This graphic shows the top 3 highest money market fund rates currently offered by financial institutions in Canada and in the United States. Comparing this to the T-bills discount charts we saw earlier, you can see that it's a toss-up between investing in T-bills or money market funds, both in Canada and in the US. Cash exchange traded funds or cash ETFs are ETFs whose daily traded shares represents its investors' pooled capital that the fund manager deposits in high interest savings accounts at major financial firms, usually at higher negotiated interest rate than individual depositors can get with regular HISAs. Cash ETFs are offered by mutual fund firms, banks, wealth managers, and brokerages, and their shares are traded daily on stock exchanges. Unlike money market funds, they return variable yields or dividends and do not guarantee their investors' principal, unlike T-bills and most HISAs, GICs, or CDs. Aside from their uninsured principals and variable yields, their returns are also impacted by various costs like stock exchange fees, brokerage trading commissions, and fund management fees. This graphic shows the top 3 highest cash ETF yields currently offered in Canada and the United States. Comparing this to the T-bills discount charts we saw earlier, you can see that it's probably better to invest in cash ETFs over T-bills both in Canada and the United States. Right, that does it for cash and cash equivalents. Next, we'll delve into the real estate asset class. Real estate assets go beyond owning shares in publicly traded real estate businesses. In fact, while US financial real estate assets, or the real estate equity sector, was valued at $1.4 trillion, the total value of the US housing market, or physical real estate assets, reached an all-time high of $47 trillion in June 2023. Owning physical real estate assets involves buying a house, rental property, or land. Meanwhile, owning financial real estate assets involves buying shares of related businesses on the stock market. Physical real estate asset returns come in two forms: regular payments from renters or rental income, and capital gains or the surplus of the selling price over the buying price. Physical real estate assets fall into 5 buckets. Residential real estate includes single-family homes, condos, cooperatives, duplexes, townhouses, and multifamily residences. Commercial real estate includes apartment complexes, gas stations, grocery stores, hospitals, hotels, offices, parking facilities, restaurants, shopping centers, stores, and theaters. Industrial real estate includes property used for manufacturing, production, distribution, storage, and research and development. Raw land includes undeveloped property, vacant land, and agricultural land such as farms, orchards, ranches, and timberland. Special use real estate is public use land like cemeteries, government buildings, libraries, parks, places of worship, and schools. The number of new residential construction or housing starts is a key indicator of the health and direction of the physical real estate market, which is governed by supply and demand. Construction is materials and capital intensive and usually funded by loans, so inflation and interest rates significantly impact real estate values, as you can see from the yellow and gray lines on the housing starts and interest rate charts, both representing recession. Rising inflation increases building costs by raising materials and energy prices as well as construction workers' wages. This reduces housing supply and inflates existing and new home values. Moreover, rising interest rates, which usually follow rising inflation, increases building project loan costs, which further reduces housing supply and inflates existing and new home values. If high interest rates persist for long enough, it eventually destroys housing demand and cuts existing and new home values as it slows down the overall economy, leading to cuts in business borrowing and operations, wages and jobs, while boosting mortgage and rent payment failures or delinquencies. Now let's see how things stand in the physical real estate markets of a few major economies. Yes, housing prices surged in the US in the last few years, but have you seen Canada? These charts by Ben Carlson show that Canadian housing prices rose a whopping 142% since 2005, and that's after adjusting for inflation. Meanwhile, US real housing prices have only gone up by 26% in the same period. To get back in line with US real housing price growth, Canadian housing prices would need to collapse by about 40%. And that would be brutal for existing and new homeowners. Moreover, the Canadian housing anomaly is the same on a year-by-year basis, where we see bigger gains and losses in Canada compared to the United States. Things get crazier when you pit the real gains in housing prices against the real gains in disposable income since 1975. In the US, over the last 50 years, the relationship between incomes and housing prices after accounting for inflation has been close and fairly stable, but the Canadian housing market has gone haywire in the last 2 decades or so. Eurozone interest rates had been near 0% since 2015, but rose rapidly to 4.5% beginning in 2022. One of the results is the bursting of the German residential property bubble with 4 consecutive quarters of decline, the last of which was the largest quarterly slump since records began in the year 2000. The German property crisis has already claimed Austrian property giant Signa, which had significant operations in Germany and filed for bankruptcy in November 2023. Right, that does it for the real estate asset class. Next, we'll delve into the commodity asset class. Broadly speaking, commodities are goods that practically have the same use and quality regardless of their source. For instance, no one cares where a gold bar came from, but everyone recognizes its value. On the other hand, the market differentiates between diverse brands of electric cars, although they all use nickel and lithium in their batteries, and no one cares where those come from. So commodities are the raw materials and goods that more complex products are made from. Commodities are classified as either soft or hard. Soft commodities are grown and include agricultural produce and livestock. Meanwhile, hard commodities are mined and include metals, minerals, and energy. Agricultural produce are grouped into softs and cereals. Softs include cotton, coffee, orange juice, rubber, sugar, lumber, and wool. Meanwhile, cereals include wheat, corn, soybean, rice, oats, rye, barley, millet, and rapeseed. Livestock includes cattle, beef cattle, hogs, and pork bellies. Metals are grouped into base or industrial metals and precious metals. Base metals include aluminum, copper, lead, mercury, nickel, tin, zinc, and titanium. Meanwhile, precious metals include gold, silver, platinum, iridium, palladium, osmium, and ruthenium. Minerals include the rare earth minerals of the 15 lanthanides on the periodic table, plus scandium and yttrium. Lastly, energy includes crude oil, petroleum, gas oil, natural gas, heating oil, coal, unleaded gasoline, and electricity. Directly owning commodities involves buying and storing the physical commodity, but the logistics of an individual doing this is challenging. Just imagine transporting and storing a barrel of oil. A more practical and indirect way to own commodities is by buying commodity-related equities, futures contracts, commodity CFDs or contracts for difference, commodity ETFs or exchange-traded funds, and commodity mutual funds. Commodity-related equities are shares of companies in the materials equity sector. A downside of this approach is that the share price of these firms may not correlate with real-time or spot commodity prices due to the business's financial structure, the health of unrelated businesses, and any futures contracts the companies may have. Futures contracts are agreements to buy a certain amount of a commodity in the future at a price set in the past. If the commodity's price rises in the future, the existing futures contract to buy it at a lower price becomes more valuable, and the reverse is true. These contracts are usually out of reach for individual investors due to the significant cash commitment needed and what that means for their portfolio allocations. For example, a gold contract could involve buying 100 troy ounces of gold, which amounts to a $200,000 commitment. CFDs are derivative products or financial contracts that pay the differences in price between the open and closing trades. When you enter a CFD, you are speculating on the future price movements of the underlying commodity without actually owning it. Most commodity CFDs use leverage, which can be a boon or a bust for smaller investors as it increases their exposure to the volatile commodity markets using borrowed money. Commodity ETFs are ETFs that hold physical commodities, commodity-related equities, futures contracts, or CFDs, with investors buying fund shares representing units of the ETF's total holding. Lastly, commodity mutual funds are mutual fund equivalents of commodity ETFs. This graphic from Technopedia shows the major factors that affect commodity prices. Physical or real assets like commodities are governed by supply and demand and increase in value with rising inflation. When demand for finished products exceeds supply, the cost of those products rise as the demand and price for the commodities needed to produce them spike. So in addition to diversifying investment portfolios, commodities also offer inflation protection. But their heavy supply and demand dependency means they lose value during economic slowdowns and periods of disinflation or deflation, demand decline, and supply limitations. Such periods are often caused by unfavorable market, political, and regulatory conditions, as well as natural disasters and deflationary new technologies. Since these factors are very unpredictable, commodities are a highly volatile asset class. In fact, they are just about as volatile as equities. The high volatility in commodities can be moderated by holding a diverse basket of them. That's because there isn't a high correlation between different commodities, so total returns for a basket of them should be less volatile than it would be for any one commodity. Ideally, the basket should be benchmarked against a diversified index like the Bloomberg Commodity Index. These performance charts of 5 commodity ETFs include dividends and demonstrate the benefits of holding a diversified commodity basket since 2015. Rather than being down 11% if you only own the agriculture ETF, you would be up 21% if you own the basket ETF instead. However, you wouldn't have performed as well as the gold ETF's 40% total returns. Moreover, the impact of currency exchange rates can be dramatic since most commodities are traded in US dollars. For example, in Canadian dollar terms, none of these US dollar-based ETFs have negative total returns as the US dollar became much stronger. Right, that does it for the commodity asset class. Next, we'll delve into the alternative asset class. Alternative assets include hedge funds, private equity, collectibles, and cryptocurrency. These assets are characterized by risk profiles that are orders of magnitude larger than cash and cash equivalents, bonds, stocks, real estate, and commodities. As a result of their risk profiles, owning them requires sophisticated financial knowledge or advice and investing experience. In addition to the huge profits they could deliver, some of these assets are also non-correlated with stocks and bonds and could help diversify asset portfolios. Now let's take a closer look at the different alternative assets. Hedge funds are limited partnerships of private investors whose pooled funds is managed by professional fund managers who employ a variety of risky strategies in pursuit of above-average returns. They are a risky alternative investment choice and usually require a high minimum investment or net worth. Hedge fund returns rely on the skill of the fund manager, like the famous Bill Ackman of Pershing Square Capital Management. Moreover, their returns are meant to have little correlation with the stock and bond markets. So, diversification and outperformance are what hedge funds promise. But do hedge funds consistently keep this promise on average? A 2022 study by Javier Estrada showed that very simple 2-fund or 2 ETF strategies based on stocks and bonds outperform hedge funds both in absolute and risk-adjusted returns over the last 10, 15, and 20 years. Worse still, the study found that hedge funds were highly correlated with equities by up to 89, 85, and 83% in the last 10, 15, and 20 years respectively. Javier's research used the HFRI Institutional Equity Hedge Index as a basis for hedge fund performance and showed that in the aggregate, hedge funds may not be the best alternative asset out there. Private equity involves investing in non-publicly traded businesses. It appeals to institutional and high net worth investors as returns are not as volatile as or correlated with those of publicly traded equities whose share price fluctuates daily and can see dramatic changes due to their highly liquid nature. There are 3 ways to invest in private equity: through venture capital, mezzanine finance, and leveraged buyouts. Venture capitalists invest in startups that they someday hope to either list on a stock exchange through an initial public offering or profitably sell to another company. A great example of this is Peter Thiel's early investment in Facebook, now Meta Platforms. Mezzanine financiers loan funds to late-stage startups or to established private companies that can no longer borrow money from their traditional bank credit lines. In exchange, these financiers get the high coupon rate subordinated debt of the startup or private firm. This type of financing can be significantly more rewarding when compared to typical corporate debt, and it often returns between 12 and 20% a year in interest. As this chart from the pitch book shows, there is a renewed interest in mezzanine financing following a slump in 2021. Leverage buyouts involve taking a publicly traded company private, either for its stable cash flows or to restructure and refloat it on the public markets at a profit. They declined in popularity after the 2008 financial crisis, but they are once again on the rise. Elon Musk's Twitter acquisition is a great example of a recent leveraged buyout. Collectibles are personal items that are worth more now than they were when they were originally acquired. Examples include artworks, antiques, stamps, coins, trading cards, toys, and comic books. Ideally, collectibles should pique the passion of the collector. The rarer a collectible is, the higher the price it would fetch on the market. Moreover, the value of collectibles tend to appreciate with time. They can help diversify portfolios and are fun to hold. For example, driving your vintage car on the weekends as a collector would be thrilling. Moreover, they could fetch hefty profits when they are finally sold in the future. However, investing in collectibles comes with risks. Firstly, the collectibles market is plagued by fraud and fakes. Secondly, collectibles are fragile and the slightest damage can wipe out their value. Moreover, matching collectibles to buyers who value them as much as you do can be tough. Lastly, storing, securing and insuring collectibles can be expensive. Like other asset classes, you profit from collectibles by selling them at a higher price than you originally paid for them. But the tax on the sale of collectibles is usually much higher than on stock and bond sales. Plus, you get no dividends or income while holding them for the decades it may take for their value to appreciate. Cryptocurrencies are digital stores of value or payment systems that don't rely on central banks or trusted third parties to verify transactions or create new currency units. Instead, they use cryptography to confirm transactions on a publicly distributed ledger called the blockchain. The first cryptocurrency, Bitcoin, was developed in 2009 by a computer programmer using the pseudonym Satoshi Nakamoto. This alternative asset is extremely volatile. For example, the price of Bitcoin has hit a high of $69,000 and a low of $4,000 in the last 5 years. Now that's a wild ride. Here's a snapshot of what you now know about asset classes. Clearly, there are many valuable assets you can hold, and each has a market phase or business cycle where it shines. As long as you look before you leap and you do your research and due diligence, nothing should be off the table. My take is, if there's value to exchange and profit to be made, I'm game, and you should feel the same. That's all she wrote for this video, guys. Be sure to like, subscribe, and ring the notification bell so you know when the next one drops. Thanks for hanging. Stay productive.